morning or good afternoon. Actually, good morning, no matter where you are. We're having a little bit of an earlier webinar than our standard activity here. Thank you all for joining us this morning. I know everyone's slowly hopping on the call. Got a little bit of competition this morning. We have President Biden talking about stability in the banking system this morning, and as the comments are made, we'll update everyone as it's happening at the same time. We just found out. But they are currently taking credit for saving the economic environment, the banking environment, and putting safety and soundness back in the banking world. So some positive activities being talked about there. Again, I'm Charlie McQueen, President McQueen Financial Advisors. Thank you for joining us here today. I'm joined by Craig Cecilia. Craig oversees our investment advisory activity. He's our Chief Investment Officer and Managing Director. I was on the phone with Craig last few days, pretty much nonstop or meeting. I do think one of the best quotes I did get from a client yesterday out in the West Coast was, the PTSD of 2008 was starting to shake me this weekend. And so I know there's a lot of concern, a lot of activity out there. Definitely not a normal environment that we're in today. So opening comments wise, I thought it might be good just to talk about what's happened here in the past about week. Most of this happened over the weekend, but we did have Inter-American Federal Credit Union closed, and it closed due to unsound banking practices. And small institution, nothing big. Next thing that we all heard a lot about was Silvergate Bank, which is part of Silvergate Capital. They decided to close due to market conditions. This was a shocker to the economy and shocker to the banking world. They just came in and said that they're going to close their crypto-focused bank due to market conditions and return everyone's money back to them. Really, really interesting how that happened. You don't see that every day. Next thing that popped up was Silicon Valley Bank, SVB, was closed on Friday. They had a full-blown old-school run on the bank. What made this one very different is 90% of their deposits are uninsured, where most everyone on this call, you have 90% of your deposits insured. So the exact opposite. They had a massive run on Thursday. We'll talk a bit about this, $40+ billion being withdrawn from the bank. This is the second largest bank failure ever. And that's something I think that took a lot of people off guard, that it was that big of a bank, $200+ billion. While the announcements were coming out on Sunday night that we'll talk about in a minute, and the activity getting cleaned up, quietly kind of just announced and slid in there was that Signature Bank in New York was closed Sunday night. It's very interesting. This has been a crypto bank that was leaving the crypto world and had good numbers, good earnings, good structure. The rumor that we're hearing right now is they had a request of 50% of their deposits to be wired out of the bank on Friday. And massive number. I don't think anyone could live with a 50% deposit reduction. This is the third largest bank failure in the history of the United States. So we have the second and third largest bank failures. This blows through the size of everything that failed in the Great Recession. We're looking at 2008-9, huge amount of failures in dollars compared to back then. Third thing that's been, the next thing on our list here is First Republic Bank has been in the news. First Republic Bank had people lined up at their ATMs over the weekend pulling cash out. A lot of rumors surrounding this, but at this point, JP Morgan and the Federal Reserve gave the bank a $70 billion line of credit for liquidity purposes. And Craig, if I'm correct, they have about $170 billion in deposits. Is that correct offhand with that number?
Yep, that is correct. About 170, with majority of it being uninsured.
Yeah. So you think about that with a $70 billion line, $20 billion investment portfolio, roughly. I'm close on that number. I know I'm not exact. And some lines of credit already, they should be able to cover almost all of their deposits leaving the bank. It's a lot of uncertainty around that bank at this moment. Yeah. So all these things happening, vast majority of this on Friday, Saturday, and Sunday. Well, Saturday was the quieter of the days. Sunday was definitely busy last night with all these things happening. But what additionally happened on Sunday was two things. The second bullet point here, I should swap these. SVB and Signature Bank were assigned a systemic risk exemption, which means that the FDIC was able to pay out deposits both insured and uninsured. So all deposits are guaranteed. So when you're considered a systemic institution, you get then the full ability that all deposits are insured. And this is one of the things we talk about with the large banks in the country having systemic importance. Therefore, all the deposits are effectively guaranteed. So what ended up happening with both these banks, all the depositors are made whole, and their money is available today, and they're supposed to continue forward. So this is a decision was made. These are large banks, obviously, and this decision was made to put stability into the system. Now, I don't think, and we'll talk a lot about SVB, I don't think they were going to lose money with SVB because of the size of the investment portfolio. It's more of a timing issue, not a credit issue. And the same thing with Signature Bank. It's more of a timing issue, not a credit issue. So definitely interesting position where both these are today. The second thing that happened is the Federal Reserve announced with FDIC a new program. Everyone had to get on board. The White House signed off on this. The Fed, FDIC, and the FOMC. They created a new entity, a new model, the Bank Term Funding Program, BTFP, to provide liquidity to institutions by lending 100% in the principal amount of certain securities. Now, Craig, this is limited to what types of securities at this point for the BTFP program?
So that's a great question because they reference what the Fed is called eligible collateral. And so they go down the path when looking up the definition for eligible collateral. It's basically instruments that are actually guaranteed by the U.S. government. Now, the big debate is whether Fannie Mae or Freddie Mac is guaranteed, but they do include mortgage-backed securities. And put them in a nutshell, your agency securities, your mortgage-backed securities, not private label, but Ginnie Mae, Fannie Mae, Freddie Mac, treasuries as well are kind of what, and then there's a bunch of other like U.S. Ancillary programs that are guaranteed by the government, like the U.S. Postal Service or aid bonds, but very ununique. They don't mention that in the section 102 something B that municipals, for example, are eligible. So I would expect that maybe they will change that under emergency powers, but right now they're not included in there. So it's just your normal government agency type stuff.
Yep. And what they're doing is they're not giving any haircuts. So, for example, if you have bought $1 million bond, it's now trading at $900,000. If you post that bond for collateral in other places, like the Federal Home Loan Bank, they're going to take a haircut on the bond, and then they're also going to take that haircut starting at that point with the market price. And so, for that $1 million security, you might get $700,000 with the Federal Home Loan Bank or other lenders. With this program, they would give you $1 million. They don't take into account the price or a haircut for anything. So it does improve. What it doesn't do is help people that don't have a lot of investments. That's one of the tough things here we're seeing. So to kind of go back and go through this here, what in the world's going on? Why are we seeing all these things take place? There was a full-blown run of the bank at Silicon Valley Bank, and that started to make people start to look at things very, very carefully. This all happened just on Thursday of last week as the starting point, and made it through today for a vast majority of this. So what we want to do is talk a little bit about what happened and what we should be doing today to prepare for the regulatory world and changes coming up and needs for liquidity immediately. But it's really important to realize that the Fed did step in. They're making all the depositors whole here, and they've put this program in place. And President Biden was on TV, and his comments basically said they've taken the steps to ensure that we all believe in our banking system. So a lot of things have been done. There's still a couple of banks with some significant outflows that we're watching carefully, but a lot of this is a confidence activity. And we'll get into that here as we get into our more detailed part of the agenda. Along the way, a little bit of housekeeping as I skipped, as this is an earlier morning webinar, so I made my morning and afternoon comment there. If you do have questions, please enter them into the Q&A box, and we'll answer those along the way. A lot of this is fluid. We might pop on and off and grab some new documents that come off, but if you have any questions, please add in there. We're going to talk about SVP and SBNY, what we know, what went wrong, what we expect to do going forward, words for your members or clients. We're going to go through the Fed announcement, a little bit more detail there in the BTFP, and then we have some data points we want to talk about today, and then any Q&A at that point. So what we know, amazing dollar amount of run, SVP, which was really interesting, Silicon Valley Bank, a lot of if you were involved in a startup or a venture capital fund was putting money into your your business or buying part of your business, one of the requirements a lot of the venture funds had is that you had to use SVB Bank. SVB Bank was very good to a lot of Silicon Valley startups when they were small. And so when it went over and it started to, so they had this big relationship. So a hedge fund or a venture capital fund may have 200 or 300 companies that had deposits there. And so when a few of the venture firms realized that they weren't comfortable with the risks the bank were taking as they watched the stock price fall, they told all their portfolio companies to pull all their money out. And so when one person decided they weren't comfortable with the bank, it would affect hundreds of companies that worked with them. And at the same point, the venture capital for world is very small. They started talking and everyone said, well, you have to pull your money. And so when 2 or 3 people made decisions to pull their money, it ended up having hundreds and hundreds of accounts. And this bank is very unique, very, very large deposits. You think about that, they had 173 billion in deposits, 151 billion were uninsured. So basically all these deposits were massive deposits. Craig, do you remember the number of clients that they had at SVB?
Well, it's interesting. There's a couple numbers to keep note of, but the uninsured deposits were 37,000 clients. So they had about 100,000 clients that made up about of 4 billion only of a $200 billion institution that were insured. So there are 37,000 clients made up that uninsured amount. So you think about that, there's a lot of institutions out there that have that many clients and they're only $500 million in assets, right? So a huge amount of concentration there.
Quick question popped up I want to answer. Therese, appreciate the question. The BTFP is open to banks and credit unions, just to be very clear. The way they wrote it in the beginning, it's banks. We'll get into it in more detail in a couple pages, but I wanted to answer that. It is available to credit unions to use also. All right, so hopping back in here, SVB, not only did they have a very unique grouping of venture capital firms that were their clients and big deposits, they had a stable coin with a $3 billion deposit, just to give you an idea of some of the sizes here. When this run on deposits took place, it was very painful because the bank had grown. I think if any of us on this call, if our institutions had grown like SVB Bank, we would have been locked down by regulators. So it's just very unequal treatment by regulators, but SVB Bank doubled in size in March of 21 to 22. They made it to 124 billion. They continue to grow over 200 billion. They effectively grew 4x in a matter of 3 years. And you start to look at these numbers that their capital ratios were smaller than they should have been because of the exponential asset growth. So in the end, year-end 2022, there were 209 billion in assets, and they had a big investment portfolio, 117 billion. So very, very low loan to deposit, loan to share ratio, which made them a low expectation of a liquidity crisis. Any other comments on this page, Craig?
No, covered it fairly well there, Charlie.
Thank you. All right, so part 2 of what we know. Again, the lack of diversity is shocking in the bank, but basically Silicon Valley Bank served 50% of venture startups. And as I talked about, all of them would put their dollars there, they'd keep all of their money there. And so as they took all these deposits and they grew very quickly, remember, not only are we having a lot of popularity in venture firms, but we're having a lot of popularity in Silicon Valley venture firms, looking at the price of stocks in Silicon Valley. So as they took in more and more capital, more and more deposits, they invested it. And they ended up investing it in a lot of it in long-term mortgage-backed securities. And what they did early last week that started this is they sold $21 billion in investments. They took almost a $2 billion loss. They went to the market to try to raise $2 billion of debt. And all of that started to question as they went around with the financials. The kiss of death many people are saying is that the CEO, Greg Becker, in a Zoom call said the famous 2 words, don't panic. So one of the things we want to make sure is we don't say don't panic. That always helps, I've learned, especially in communication around the house. Or no big deal. So it's really gotten interesting, and so it became just an old-fashioned run of the bank. People lost confidence in it and started to understand the non-insured deposit numbers. So what got to this point? How did they get here? And something important to think about. They clearly had very ineffective ALM reporting advice. We look at what they were doing. They did not do a good job. They had an ineffective ALCO. Anyone at ALCO should be looking at what are the relationship of all my deposits. If one VC firm covered 1/3 of your deposits, that's really got to change your liquidity structure. This is very different than most people on this call. Most people on this call are going to see that 90% of their deposits are insured. They're spread out over 30,000 different individuals, and the individuals don't know each other very well. And so this is something where they were not looking at the risks appropriately, and they weren't looking at these large deposits, the capacity to move. And they also had way too much of their portfolio in long-term securities. And I think in the end, and Craig agree with this, that SVB did not prudently diversify and ladder their investment portfolio maturities.
No, they did a small percentage of their investments in a shorter term bucket, but it was extremely immaterial amount. Everything else was just kind of long and not planning out for any kind of liquidity stress testing, for example, that they're not necessarily required to do like a really big, large institution.
So to me, it's an interesting spot here, just a really ineffective ALM, ineffective ALCO, and then they got caught in a mass exodus of dollars. So we think about this moving forward. I think to me, ALCO has always been the center of risk and liquidity management. And when banks fail, it is usually due to a liquidity issue, and that's what's happened with these two banks. But I think it's time for us to revisit the needs of proper ALCO, making sure we're going through the right things. We're working on a whole new write-up for ALCO and process and a monthly type cadence of meetings. But it's also important to remember that ALM reporting needs to be done right and needs to challenge and needs to be debated. Portfolio management needs to be done correctly. And one of the things we've seen here is there's a lot of the people point out the relationships to the COO at the bank and who was the CEO of Lehman, and all sorts of different things that are coming around about the bank. But some of the things we'll look at here is it appears that they were sold a whole bunch of long-term bonds that brokers wanted them to take, instead of buying bonds that fit the needs of their interest rate risk component. And this is where it gets more important, where interest rate risk in the ALM component is extremely important for designing your investment portfolio, but also the ALCO component of that, which is going to say, hey, here's the concentration we have in depositors. Here's the different issues we have going on. And that's where ALCO has to come in and work with your ALM reporting and work with your portfolio management. So to me, it's really interesting. There was a disconnect in risk and the investment portfolio, and that's one of the big downfalls that took part here. And so here, I do think we're going to see a really big focus on obviously liquidity, interest rate risk, and ALCO, and making sure that ALCO is helping design an investment portfolio that is appropriate for the institution.
Yeah, I like how you said that, Charlie, because when institutions are talking to the markets and their brokers, and they sometimes, I want to use a term, it's probably inappropriate, but I'm going to use the term, drink the Kool-Aid of saying, hey, this is the best yielding security out there, maximize your earnings, without taking into context a lot of other components of your balance sheet and interest rate risk management, because the highest yielding security is not always the best security for anyone's situation. We all know that. And so incorporating interest rate risk modeling into portfolio management, it is really the foundation of actually properly managing your balance sheets.
Yep. And I think it's tough. A lot of people say, well, this is the highest yielding bond, I want to make the most money, and making the most money is not always the correct answer. Again, moving forward here, a little bit more detail. Some of the things that we think that everyone should be doing today. What should we be doing based off of what's happening? And what we've seen today and last night, which many of you read our email we sent out yesterday in the afternoon with the viewpoint that we expected communication last night. And we did receive communication greater than I expected, but we did receive communication. And that was to make sure the markets calm down and people understand. And Biden's comment this morning is the banking system is safe, deposits will be there when needed. And so we're getting the message out, and that's how you stop a run on banks, is to let people know it's a psychological activity, let people know that everything's okay. So for everyone on the call today, my first recommendation is this morning that you need to provide talking points to your team. We've seen a bunch of different versions of those talking points. We have an example here in a minute that I'm going to show you guys, but we really want to make sure you're talking about how you are different than SVB. And we are starkly different. Everyone on the call here, we're very, very different when you start to look at the insured deposits versus uninsured deposits. Clearly communicate any issues with your team and your MFA advisor. There are things we can do to help. There are people we can bring in. There's activities. But if you're seeing any issues, talk about it sooner than later. Don't wait and see what happens for a day or a couple hours. This is something we're going to want to watch. If we are seeing people wanting to withdraw deposits, we want to make sure that we're very, very upfront and that we have these talking points that all of our team members know and that they can share with your customers or members to make sure they feel comfortable.
Yeah, that's a good point there, Charlie. When you say the word team, I think of an entire organization all the way down, because everybody has a touching point with a customer within your organization, not only for your C-level management, but also your customer service reps, your tellers, anybody that is working at organization should be brought down to that level of giving them good talking points. They don't have to be overly complex, but they need to be reassuring.
Yeah. So once we have the talking points in place, you've communicated with your team, we do think it's a good idea to revisit identifying your deposit concentrations and think about that. One of the things we had a long debate about last night and some internal phone calls was messaging. Do I want to call every one of our customers or members? Do I want to post messages on the web to talk about how safe we are? One of the things we look at, most individual and depositors just aren't going to pay any attention to what's happened at all. And it's not going to be a big deal. We may want to be more proactive with some of our larger depositors, and we have concentrations to make sure they understand the safety and soundness of the institution. If you are low on liquidity, Greg, one of the comments you have here is, if you don't have cash, go borrow some.
It's a good point. But this event is a little bit different than we had with the Great Recession, and we don't necessarily know how it's going to spread here, because one thing you mentioned appropriately was it's not a credit event. This is a liquidity event. We know it's top of mind for both the NCUA as well as the FDIC as well as state examiners of liquidity. And so we've seen that liquidity throughout the end of 2022 into the first quarter of this year, as liquidity has been going out the door. They're decreasing the M2 money supply. They're going to continue to do that. And we have deposit growth that has stopped. And if we do have a situation where we want to be able to meet any kind of client demands, whether it's a commercial relationship or some high net worth individuals that have over insurance limits, want to have a little bit of that liquidity around. And our recommendation is well, as we talk to clients, is do you have cash? Well, I have cash, but I'm borrowing to have that cash, and that's okay. But what we really want to think about is maybe move from an overnight to a 2-week, a 4-week, a 30-day. We got quarter end coming up, but we also want to make sure that the things settle down with this actual situation in the marketplace, and having a little bit extra cash for that is what it would cost for insurance, meaning having liquidity, you're going to have some interest expense that you normally wouldn't have. Quite frankly, the curve's pretty flat, so whether you borrow for 30 days or overnight, it should be fairly equal in cost. But having that term deposit in there in case there's other facilities that do dry up a little bit. We don't expect that, but we think it might be prudent for everybody to have that little cash laying around just in case.
It's I think Craig pointed really well. March 31, we want to be careful. Think about that as our quarter end reporting to look at asset size and capital ratios. We don't want to have something that offsets us in a bad way, so be very cognizant of that. But having enough cash right now is extremely important. Identify loan closings. What do we have coming up loan closing wise? What are we doing to make sure that we're funding that? And I like this last one you put together here, is identify loan types that can easily be slowed down in the event you need to curtail lending. This is something where we really have to look at what core lending to our customers or members is, and what is non-core lending we're doing to people that don't have their deposits with us. If someone has their deposits with JP Morgan, are we going to require them to bring them to us as part of the loan? And that's some things we really need to think about, is making sure that we're lending to our membership and not to people that are saving money in other places. So something really, really important to make sure. Controlling of lending growth has been one of the most difficult things here in the past probably 90, 100, 120 days-ish. All right, so going forward from today, again, just to go back real quick, today what we want everyone to do is make sure you have talking points. We'll give you some examples. We sent some examples out last night. 2 is communicate clearly with your team. If anything comes up, also communicate clearly with your advisors here at MFA. And then really start to identify any concentrations you have. Make sure your cash position is good. Make sure you know what your outflows are going to be. and identify your collateral, that your potential loan areas you can slow down. Now we get to this week. There's a lot of things we can do, but one of the things we want to do is make sure that you're starting to review your liquidity position on a daily basis if you're already not doing that. We've seen, Craig, a lot of people go from quarterly to monthly, now to weekly reporting, and even daily reporting. You're seeing that trend happen?
Yeah, we've been seeing it quite a bit, especially as we've seen the liquidity in the market start to really change directions. The worm has turned, if you will. And as in conversations, one of the things that we discovered is on that daily liquidity monitoring, it can be defined in a couple of different ways, right? Well, let's just go look at our balance in our account, and all right, there's our liquidity. So that's not necessarily the best way to do that. You want to kind of look at what is your forecast of closings, your term deposit roll-offs, and your pipeline that could turn into, and manage it a little bit closer. It's just very prudent, and documenting that would be great as well, because regulators are going to use this as a good example to cause you to do that type of monitoring. And it's really important to make sure you understand, because if we have a change in your liquidity that happens really quick, it's, facilities may or may not be there. So yeah, very important to monitor it very closely on a daily basis.
The other thing, when you're doing your liquidity policy this week, your liquidity position, you also need to review your liquidity policy. Your liquidity policy is going to have activities that you need to take if liquidity changes and there's a liquidity event. So you want to dust the policy off, get it out, get ready to understand what it means to do if you hit a liquidity event or market activities. I think here, this is something to really think carefully about your ALM position. I know there's not everyone always agrees with every comment, every review point, but make sure you understand your interest rate risk position, what happens if interest rates go up or down, and then also review your investment portfolio. Remember that there is a balance of liquidity, earnings. We go back to the basics: safety, liquidity, and yield. That's the important. Safety and liquidity start first, and then we get down to yield at the end. So really need to make sure, and we're very confident in all of our investment portfolios with us, but make sure you've looked at this carefully. And then also review your borrowing lines. But before I leave the investments, again, making sure your investments are doing what your ALCO and ALM needs, not what a broker says you need to buy. Really, really important. You need to make sure you are controlling that process, and that's something that we do with a lot of our clients here.
Yeah, well said. Part of also in that investment portfolio is just making sure to assess your HTM holdings versus your AFS holdings, and implications if you need to utilize HTM securities in an event of liquidity, and what it means to that entire portfolio where you have that intent of HTM. Very important to understand.
And then reviewing your borrowing lines of credit. We've talked with a lot of correspondents, corporate credit unions over the weekend. We've talked to a bunch of regulators over the weekend. All lines are open if we're needed. It's something also good to remember. Having multiple lines of credit is not a bad thing. You've heard us say this over and over again the last couple of years. When no one needed money is the right time to get those lines of credit in place. I actually gave advice to people to do your individual home equity lines of credit. Make sure you had those in place. But continue to review your borrowing lines. Make sure that you've got ample liquidity through borrowing lines.
Yeah, and on that point, there is one of the questions that we do get asked often is I do have a couple of lines. I got one with my correspondent bank or my corporate credit union. I have my home loan bank, and I'm just going to pull my line, or I'm just going to tap into my line at the home loan bank. And thinking about that a little bit is you need to use collateral for those borrowings. And in certain uncertain times, I really like to encourage utilizing lines that aren't requiring capital, and save some of your powder for down the road if we do need it. So consider that as well, please.
Yep. And also, if you are getting in a tight spot, to think about, and one of the things we can help you with, if you have a lot of mortgage-backed securities or mortgage loans, if you have a lot of mortgage loans, those are not pledgeable to the new facility that's been created, the BTFP, but we can always securitize those loans. And we can securitize those loans, and they are pledgeable. Those are usually pledgeable to the Federal Home Loan Bank, but we have to look at the haircuts and determine how big that is. So if you are concerned about liquidity, there's something to bring up with your advisor. There's a lot of different avenues we can take to really look for ways to work with this new program, the BTFP program, and other ways to optimize your borrowing capacity. Mentioned this a few times. There's words here. This is a different set than we gave out last night. This one came out. I thought it was really nice. We're seeing a lot of different examples float around the internet right now, but you know, your entity, our institution remains well capitalized and well positioned to continue to serve our customers and community. We were chartered X years ago and expect to serve this community for generations to come. You know, this goes through and talks about that no one has ever lost a dime. One of the important things here is, again, focus towards your people, your customers, your members. And this is where the deposits up to $250,000 are going to cover a vast majority of all of the members of all of our credit unions and customers of all of our banks. In the end, if you'd like to learn more about FDIC or NCUA coverage, here's a link. And if you have any questions, here's our phone number. So just a simple thing. There doesn't have to be a lot of explanation. We don't need to break things up. One of the things I do like, and we did send out last night, is say, by the way, 98% of our deposits are fully insured, unlike SVB Bank, which only had 10% of its deposits fully insured. You know, very, very different outcomes. So again, consumers are not going to understand a lot of this. This needs to be more technical, and this is where some of your larger depositors are really going to have to focus on this. But key here is communicating, making sure everyone in your institution has these talking points in front of them. All right, things got a little bit crazy Sunday night, and this is where we talked a bit about this, but this whole process had to go through the FDIC, the Federal Reserve, the President, Secretary of the Treasury, all had to approve actions to enable the FDIC to complete the resolution of Silicon Valley Bank, and also the same thing with Signature Bank. And the importance here, and this is part of the frustration I have with what happened, is the good news is that they're protecting all depositors. And how they did that was by determining here that these institutions were all systemically correct or important. And so they made the comment of systemic risk exception. And what allows them to say is, since these are systemically important, we're going to back all the deposits. Now, my frustration level here is, instead of them going down this path, I would prefer that they would have said, we are going to make all deposits insured. And this is something where I do think our trade associations need to work very hard at this. Around 87% of all deposits are in systemically important banks, the top 10 banks. And so now we're just looking at another about 13% that we should insure 100%. So we're on a level playing field. So something really important about this does put a bit of a favor towards larger banks that are considered systemically important. There's a lot of conversations we're hearing about people wanting to move deposits to bigger entities because they're systemically important. All right. Question just came in is, can you clarify per share owner? The standard share insurance amount is $250,000 per share owner insured, crediting for each account ownership category. So you can structure deposits to have more than $250,000 done. So for example, you could take a member who is married. The member can have $250,000 or customer in their name. Their spouse can have $250,000 in their name. They can also have $250,000 in a joint account. So we can insure $750,000 when it's just two people. If they have kids, you can do another $250,000 if you do a joint account with a kid. So there's a lot of ways that you can structure to get much higher than $250,000. Craig, any additional comments on that?
Nope. Yeah, that's how who you have in the household is what happens when looking at that insurance. So well said. Can't add to it.
You can definitely spend some time working on structuring accounts. Normally what happens in a bank closure that you are encouraged to call all of your customers and structure your accounts. That clearly did not happen over the weekend, but it's definitely a normal institutions. That's what happens. So there's very little loss to depositors.
Yeah, there was a calculator on both the NCUA as well as the FDIC for insurance calculations, or a calculator that might be a good thing to provide to customers of the bank or members of your credit union, whichever. And I think it's still out there, so and a household can calculate out, what is my insurance levels based upon who I have in my household, and count names and captions to maximize your insurance.
Yeah, thank you. The other thing that happened Sunday night, it's a little bit of a repeat, so we cover this a bit more in the beginning here. But again, the BTFP has been designed to provide liquidity. So if you have an investment that fits that number, they're going to give the full dollar amount. If it's $1 million bond that may be trading at 900,000, you can still get $1 million for it. It is for 1 year. At the end of 1 year, if you still need the funds, there's a backstop fund they've put in place. But it's unlimited lending for the first year, and then they have a cap for the second year, but they're not worried about they need to grow that cap. So it's there for 1 year. A great question came across: should we use the BTFP even if we don't need to? So this is where it's going to be a very individualized look at your balance sheet and your liquidity position. And I'd want to compare the assets that we can pledge to this versus the Federal Home Loan Bank or another corporate lender, because that's where it could be really interesting. So to me, it's very, very interesting spot where it may be something to look at and use, but it's going to depend on your liquidity position. I do like it because it's 100%, but we also have to remember it's a repo activity. And so what we're doing is we're taking a security, we're pledging it, this $1 million security, and we're getting $1 million of cash. So if your security yields 2%, we're going to end up then borrowing this money from the BTFP. And Craig, that was 10 basis points over the swap curve. Is that correct?
Yes, correct. Yeah, so it's going to be similar, and the swap yields are similar to treasuries. So you're talking, actually we've had quite a rally, but you're talking 4+%.
So then we're looking at a negative 2% type number spread on that. So you have to make sure that we're also having good earnings, and we're careful. So this is something that I think is a good program. Should you use it if you don't need it? If we look at your liquidity needs, it might be something that makes sense to use. So it's going to be very individualized. All right. And then Craig, there was a comment about the FDIC tool. What was that called?
It's FDIC insurance calculator.
Okay.
Is what I would have to take a look and try to get that.
Yeah, it's EDIE, just popped up, Electronic Deposit Insurance Estimator. That was.
Thank you.
Yeah.
Yes.
Cool. All right. Thank you for that comment. All right. So let's talk a little bit about history here, because what ended up happening is no one lost money in this closure. If we look back in history, it was really interesting. Let's start with recent history. From 2009 to 2013, only 6% of money was lost in bank closures. So that's the recent future, and that's why wasn't as concerned about SVB closing. I didn't think it'd be a big loss to depositors, but it's obviously zero. But even going back to the 80s, 24%, 14%, 1992 to 2007 was pretty ugly, 65% losses, and this is the losses on uninsured deposits. Pretty wide range of numbers throughout the history here, Craig.
Yeah, I think they've kind of learned how to best stabilize the industry, quite frankly, and realizing that the backbone of commerce is the banking, and I think the government has been slowly but surely creating new tools and more creative ways to stabilize things when we do have problems. Unfortunately, it's not a perfect system, like you mentioned. It almost seems discriminatory towards smaller institutions, but before versus systemically important institutions, especially when we're not necessarily in smaller community space doing anything necessarily wrong. We're just doing our thing and getting victimized from a liquidity standpoint, potentially just being related to the industry. So, but they are getting better at helping stabilize things for us.
Yep, definitely big differences here. And we did get the 100 to 250,000 2008. I forgot about that. Yep. But that was a big change too. So one of the things that's really come out, there's a lot of data here. JP Morgan put out some great data over the weekend, which made them look really good too, which I thought was pretty nice of them. But this chart here, and let me just give everyone a little bit of what the chart is and ask Craig to give us some comments on this. So here on the left-hand side is estimated retail deposits shared total deposits. So, and we're looking at the retail deposits. And here is loans plus securities as a percentage of deposits. And so as we get farther out here in the risk curve, it's the loans much higher numbers, and we also get much higher numbers here where this is good, this is retail, and this is bad, this is no retail. And so Silicon Valley Bank out here, SVB was their ticker symbol was a outlier here where they were, the big numbers, but also extremely low retail. So there's just very, very big deposits. Citigroup is not as bad as them here, but there's still an interesting spot. But then we see a lot of the other banks all kind of grouping together here at a more of a normal range.
Yeah, this is just a fascinating chart to me, and I think about it from our customer base is the majority, unless you're a business bank, we're going to have a much better diversification of deposits with a lot of good core deposits and whatnot. But the part I want to really talk about is the loan to deposit plus securities as a percentage of deposits, because as people try to look at and maximize their loan to deposit ratio, right, to try to become a more high performing institution, higher loan rates and stuff, you've really got to look at what your liquidity policy is as well as your contingency policy a little bit closer. Not that everybody's is important, but when you've got a really high margin or leverage balance sheet, it's extremely important to make sure you have everything in place for the event of a liquidity event. And then also on top of that is the frequency of liquidity stress testing is extremely important the closer you get to 100% loan to deposit ratio. And that's one of the things that all examiners are going to be really big on this year as they come through your institutions is how are you stressing your liquidity, for obvious reasons. But that was coming out when they printed what their high focus items were in fourth quarter for this upcoming exam cycle. That was already there. So just today's and weekend events is really just more proof of why we need to have people do that.
Thank you, Craig. Appreciate that.
You betcha.
If we look here, there's another neat chart that came up. We're looking at, it's interesting here, is we're looking at impact of unrealized security losses on capital ratios. And we look at capital ratios as a percent down the left-hand side and then company names across the bottom. JP Morgan's at the highest level of capital and also the highest level of capital when it's adjusted for unrealized losses after tax. They're tax affecting. SVB is a bit of a standout here, I think.
You could say that, yes.
Yeah. So this is something that's really important. We need to make sure, as we talked about, Craig talked about a minute ago, is making sure we're looking at held to maturity securities and available for sale securities and looking where our capital is. And so when they were forced to sell at SVB, they ran out of capital because they had to sell very quickly. We look at all these other institutions, we still have some good capital ratios, but they're not the most exciting. And this is why what they've done is by creating this fund, by creating the BTFP, instead of Bank of America, for this example here, taking a hit of going from 11% capital down to 6% capital, they can just pledge those securities and get the liquidity they need. And so what it's doing is causing you not have to sell your investment portfolio if you don't want to. That's the whole reason for the BTFP program. It is not going to help from a liquidity standpoint substantially for someone that doesn't have an investment portfolio. This is going to help someone that has a large investment portfolio that needs to sell. Instead of sell securities, they're just going to borrow. It is going to be expensive. Again, we're borrowing at 4.5%, as Craig mentioned a minute ago. And so we're going to have this negative yield between our borrowing and our asset, but it's better than selling that asset and taking the big loss on day one. Any other comments on this chart, Craig?
Nope, that's well said.
All right. Well, this really shows through the data, and this is why, again, the BTFP fund has been put in place, and this is the scare. Now, this is FDIC data only, not credit union data. At this point, we're working on getting that data. But what we saw here is a combination of held to maturity and available for sale. And again, a lot of people, as Craig, you mentioned, have these held to maturity portfolios that are hiding a lot of their losses. Not that's a bad thing, but if it comes down to pure liquidity, this is where the BTFP is going to be able to help.
Right on. Yeah, because when you start to move securities out of your HTM and sell for liquidity reasons, the word taint kind of starts to come in there, and it would potentially cause you to have to market even some of the securities that you didn't have to sell in that HTM. So that's where the big problem comes in there, and making sure you manage what is the balance between the two of them.
Yeah. So with this, a lot of things are happening. I think this chart here really explains the BTFP and why it is being done and how that's going to help. And so instead of taking actual losses and hurting actual capital and having to raise capital, we have a fund in place now so we can just keep the securities and go forward. That is going to put a stress on earnings. And so we look at here, I think really the key is understanding that we do have another tool in the drawer that we can use. We can also use Federal Home Loan Bank advances, corporate credit advances, correspondent bank advances, a lot of different tools out there, brokered deposits. We need to make sure that we are looking at all the different tools and making the best decision we can, because the key here is this is going to be an earnings strain. We are going to see the cost of funds go up because of all these things happening. And as cost of funds go up, and if we have to borrow versus sell, that puts more strain on us. So one of the things we did in our last webinar, we talked quite a bit about making sure we price loans correctly and that we're investing any excess cash we have correctly. Really working hard on the asset side of the balance sheet to improve earnings is going to be extremely important, because what we're seeing here and in the charts you've all seen that we haven't included in this webinar is, as Craig mentioned earlier, M2 is declining, deposit bases are declining, people are looking for deposits, and that's going to cause the cost of funds to come up quite a bit here in the next couple months. One thing and where we see sometimes deposits leaving institutions right now is to the Treasury Direct. We see people spending money, and you can look at your outflows that they're going to Treasury Direct. There are also a lot are going to brokerage firms, as I can go and buy 6-month treasuries, 6 months bills yielding 5%. And so that's a big difference than a lot of money market funds that people have at their institutions. So we do think this is going to be a big push here for liquidity and earnings, which is really going to focus on making better decisions on loan pricing. So we're going to pause here and open up for questions. And we'll talk a little bit, well, as questions come in, to talk a little bit, Craig and I, about what we're seeing. Some of the things that we're seeing right now is people very concerned about liquidity and making sure that they're borrowing. Some other things we're looking at is making sure we get that messaging down and out to all of our internal people in our organization today, and then carefully getting that message out to your customers. Other comments you think we should be working on today, Craig?
Just a little bit of a follow-up. We don't have in our client base and people participating in the call today a lot of uninsured deposits, but we know there are. They're there. And one of the things that we are also kicking around as we were talking over the weekend is some steps that our clients can do to be proactive to just mitigate some of the outflow that may happen based on the headline risk of uninsured deposits, is to run and understand something you said is your deposit concentration. Get a list of all of your households that or businesses that have overinsurance limits, and see what you can do to help them restructure in the event they need to, in the case they are worried about that. Using that ED tool for a regular household and businesses. There are also tools out there, IntraFi, for example, for swapping deposits. So taking care of your customers, maintaining within insurance limits, and making sure that they're comfortable and not having to worry about insurance, utilizing that tool as well. So, that little proactive step, you may have time to do, you may not need to, but the ones that do have a little bit of higher level than an average community institution, it's not a bad way to go to be a little proactive for that with your team.
Good point. Thank you. Well, as we wrap stuff up, I do think just a couple things. What we know, SVB had a major run on deposits. Again, a quarter of their deposits trying to be withdrawn on Thursday alone. They couldn't generate liquidity fast enough. That run on deposits was based off of them taking a large securities loss and then trying to get capital, and then the venture capital world losing faith in the bank and telling everyone to pull their money out. SVB, it's shocking to see that big of a number. It appears that also then sparked a run at a couple of other institutions, but primarily it was Signature Bank in New York. were a massive run. We've been told that somewhere around 50% of their customers were trying to withdraw their money on Friday. 50% deposit on Friday. So huge number based off of rumors and things happening. Why did this happen? Well, if we look carefully, it's growth. Unbridled growth happened at SVB, and that put it in that position. I also think we look at Signature Bank, huge growth, and also getting into the crypto space and then trying to exit the crypto space. I think we'll see in the end that that was just a contagion activity. There's no reasons for that bank to have had the problems it had or others. We've got a couple other banks that we're making sure that are going to continue to do well. We look at in the beginning of our comments, we talk about the bank in the other bank in California, where we see First Republic Bank. They've gotten tons of liquidity. We expect that they'll continue forward. So hopefully we'll see this will be the last of the closures because of all the backstopping that's happened. But again, it's been runs on banks. These are extremely important to understand. These are the second and third largest failures between Silicon Valley Bank and Signature Bank. And all that appears here, there's no credit issues. There's just a good old-fashioned run on the bank from a depositor standpoint of people running out. And in the end, especially with Silicon Valley Bank, it appears that they have more than enough investment portfolio to cover all their depositors. So we do think these are two unique activities the Fed has taken by calling SVB and Signature systemic, and then giving out 100%. That's going to definitely give confidence to the market. And then the BTFP program is going to stop people that are having problems with the ability to sell securities and create liquidity. It's going to give them liquidity. So with that, thank you all for attending. We're going to know everyone's got a lot to do. We're going to take a step back and let everyone think. If you have any additional questions, please reach out to your advisor. We really appreciate you spending some time this morning. It's been a crazy weekend. We're going to continue with more information going out. We also have an ALM 101 webinar coming up later this week on March 15th, 2 to 3 p.m. I'd love to have you join that. This is really going to push even more importance on ALM, liquidity, back testing, liquidity testing, and making sure that ALCO is working properly and really giving good advice to how an investment portfolio should be structured. So really key information that's coming up at our ALM meeting.
Yep.
With
that webinar may be a good tool for all of our participants today to do a little bit of board training as well. You may have new board members over the last quarter or year and stuff, but a reaffirmation of training for them to have them participate. So all are welcome to jump on that webinar.
Cool. Thank you, Craig. Appreciate your insight as usual and expertise. Thank everyone for joining us.
Yep,
Hope everyone has a great Monday. And if you need any help or if anything comes up, please let us know. We're here to help. The entire organization is here. Your advisors are available. And all been briefed on this after some great meetings this weekend. We look forward to talking to everyone soon. Good luck today.